Hello everyone and welcome back to the channel. Today I'm talking about something that I get asked about all the time. Undervalued and cheap stocks to buy right now. Cheap is a relative term in the world of investing, but what I'm going to share with you here are 4 companies that I believe have immense long-term potential and they are trading at a price that I'm happy to buy more shares of them right now. The first stock in my list is Novo Nordisk. If you have been paying attention, you know that the share price of Novo Nordisk has absolutely plummeted in the last couple of months, dropping over 60% from its recent highs. It's been a brutal sell-off. This is a classic case of market panic. The headlines might be screaming about new competitors, illegal compounders that's eating the market share of Novo Nordisk, or Trump administration tariffs and pricing issues. But what the market is missing is the bigger picture. Novo Nordisk is still the global leader in a medical revolution in GLP-1s with Ozempic and Wegovy. These GLP-1 based medications are not just drugs for diabetes or weight loss. They are powerful tools for mimicking human hormones that are fundamentally changing the healthcare landscape forever. The market for just one of the current commercial applications of GLP-1s, weight loss, is absolutely massive, as you can see in this chart from Goldman Sachs. The analysts from Goldman Sachs believe that the global anti-obesity medication market may touch $120 billion by 2035, which is massive. And we are just in the very early phase of the growth. Okay, now that we understand the importance of what Novo Nordisk does, let's look at their financial statements and numbers. Look at this beautiful revenue chart for Novo Nordisk over time. They absolutely killed it with this explosive growth in the revenue over time. Same with operating cash flows. If we look at the recent quarter, for example, last quarter Novo Nordisk still reported double-digit revenue growth, a profit margin north of 30%, and demand so high that they're literally struggling to keep up with production. Their revenue growth CAGR for the last 5 years is close to 23% year over year. The valuation? It cannot go any lower. Novo Nordisk trades for a price to earnings of just 13 and price to book of just 8.65. This is one of the lowest valuation of the stock in their history, and compared to significant growth in revenue and earnings, this is extremely cheap. To me, Novo Nordisk is a pure example of asymmetric risk. Very low downside risk and huge upside potential. And that's exactly why I'm buying more shares of Novo Nordisk at the moment. I had 120 shares of Novo Nordisk before, and recently I bought another 69 shares. So right now I have 189 shares with an average price of $55. I talked about fair value of Novo Nordisk recently in another video, and fair value for Novo Nordisk was around $70. Market is looking at short-term competition, but I am looking at numbers and a decade of rising demand for weight management and metabolic disease solutions. The core of the business has not changed, and I believe this 60% drop is a massive overreaction. And it has created an incredible opportunity to buy an amazing company at a fraction of its former price. So stock number 2 for me is Constellation Software. On the surface, it might seem strange to call Constellation Software cheap. Their share price has surged dramatically in the last 5 years, and for good reasons. Constellation Software business model is just brilliant in its simplicity. They acquire small niche software companies known as vertical market softwares and then let them run with great deal of autonomy. They have made hundreds of these acquisitions over the years, and the result is a massive diversified portfolio of mission-critical software businesses. They buy small companies, they optimize them, and the strong cash flow from these companies is then used to buy even more companies. This decentralized approach allows them to find value in places that larger competitors simply cannot touch. This stock isn't cheap by traditional metrics, but when you look at the track record of consistent growth, the brilliant capital allocation, and the durability of the business model, I believe it is trading at a significant discount to its intrinsic value. Constellation's return on invested capital are insane, and they have been compounding earnings for over a decade. For Constellation, you should not look at price to earnings, and you should always look at their cash flows. I recently did a discounted cash flow analysis on the stock, and the fair market value was close to 5,300 Canadian dollar. You may ask, what happened that share price of Constellation dropped almost 18% from its peak? Well, it wasn't the earnings report. The stock was actually up over 5% after the recent earnings, and market completely liked the earnings report. In fact, this drop in the share price, I think it doesn't have anything to do with the fundamentals of the business. It is a wider drop in software companies in the market due to AI concerns. Some analysts believe that AI will eat the market share of software companies, and therefore they started to lower their price targets for all software companies in the market. Companies like Intuit, Salesforce, and of course Constellation Software. This is probably the most ridiculous downgrade I ever seen. The company numbers is amazing. They just reported a strong growth and capital efficiency for Q2 2025. Their software businesses are as strong as ever, and analysts decided to suddenly reduce their price targets because they just realized LLMs can also help with coding. They don't understand how vertical software work and how sticky are these small software businesses, and what are the costs of switching a vertically integrated software for a business. Look at this short video clip from one of the analysts talking about why Constellation Software is a sell right now.
What's been your observation on how Canadians are observing tech stocks that are listed on the TSX like a Constellation?
Yeah, that's a good point. We're really seeing it. The golden child right now this year is Celestica, and Constellation is up today, which is great, but it really hasn't performed as well. They're a different type of business model. They're into the vertical markets software where they're out buying niche software products, and they've been doing this for years and years and years. The issue with it is that they're taking their free cash flow and buying more businesses. And so their revenue is up 15%, but their organic revenue is up only 5%. So without out there buying new businesses with their free cash flow, they're not compounding their cash flow. So I think that there could be some benefits if they would perhaps increase their dividend and focus more on just growing their organic business.
Okay, he believes that Constellation Software isn't compounding their cash flow, and his solution for the stock is that they should increase their dividend. It's really weird. That's the only thing I can say. Constellation Software is the definition of the compounder that was able to grow their cash flow incredibly fast in their history. The growth never came from organic growth. It always came from successful acquisitions. Telling a high ROIC company, which is a serial acquirer, to pay dividends instead of reinvesting in themselves absolutely doesn't make any sense to me. But here we go. I don't even know if this analyst really studied this company in any depth before this interview. I don't know what to say. Well, anyway, I'm happy that I'm able to pick up more shares of Constellation Software at cheaper prices. I had 3 shares of Constellation, and I just bought another 2 shares of the company this week. Now I have 5 shares with an average price of 4,760 Canadian dollar. Stock number 3 for me is LVMUY or LVMH. When you think of LVMH, think of brands like Louis Vuitton, Dior, Tiffany & Co, Moet and Hennessy, and stores like Sephora. LVMH is the king of luxury sector. Now, luxury sales have been cooling off in China and United States, and that's exactly why the stock is interesting right now. The slowdown has put pressure on growth numbers, causing the stock to show negative growth numbers in some sectors in the last 2 quarters. And this is reflected in the share price as LVMUY shares are down almost 50% from its previous highs. But LVMH customer base isn't going anywhere. Ultra wealthy customers tends to buy luxury no matter what. And when sentiment turns, the upper class customers will be back and luxury sales will rebound fast. The main difference between LVMH and ultra high-end stock like Hermes, for example, is that Hermes customers are pretty much all ultra wealthy, but LVMH customers are a mix of ultra wealthy and upper class customers. which means in not great economic times, LVMH growth numbers will be much more affected than Hermes, but it also means in good times, LVMH growth numbers can take off more rapidly, especially in the retail business with Sephora. The real strength here is LVMH's portfolio effect. They own so many of the world's most desired brands. They're not reliant on any single product or trend. They are a diversified collection of global powerhouses. What I love about LVMH is their pricing power with their top brands like Louis Vuitton and Dior. They can raise prices 5 to 10% and the customers will still line up. LVMUY fair value is currently close to $150, even with much slower growth potential. And if they are able to reignite their growth, the stock can easily go back to $200 per share. There is a huge insider ownership and the management team of Louis Vuitton is still buying the dip of the stock on open market, which is yet another sign that the stock can be undervalued here. To me, LVMUY upside potential is huge and the downside risk is limited here at this price. The recent market noise has created a perfect opportunity to buy this high quality compounder at a price that doesn't reflect its long-term potential. The stock is not going to double in a month, but this is a stock that you buy and hold for decades. And that's why I continue to buy more shares of LVMUY here. And finally, the stock number 4 for me is Intact Financial. This is Canada's largest property and casualty insurer. Not the flashiest business, but here's why I love it. Insurance is predictable, boring, and incredibly profitable when it is run well. Intact has been steadily growing premiums, expanding their business into specialty lines, and here's the most important part. Underwriting profits are strong even in a tough claims environment. They have one of the highest combined ratio in the insurance industry across the world, and that's why the stock always trades at a premium compared to other insurance companies. They also benefit from history of smart acquisitions that have expanded their geographical footprint into Europe, Ireland, and United Kingdom. I recently did a discounted future earnings analysis on Intact, and the fair market value for the stock was around 295 Canadian dollar. In case of book value, which is another important metric for an insurance company, Intact trades for a book value of almost 2.8, which is higher than average for insurance companies, but compared to historical book values of Intact and the premium quality of their underwriting, I believe the stock trades slightly below its fair value. In a world where many companies are struggling to generate predictable cash flows, Intact Financial stands out as a defensive and rock-solid company that can provide stability and compounding returns to a long-term portfolio. Basically, every 5 years, Intact Financial shares are doubled in the history, like a clock. Almost 100% return after 5 years in different time periods. And that's why I picked up another 20 shares of Intact Financial during this dip. Now I own 40 shares of Intact with an average price of 295 Canadian dollar. This is a great stock that is trading at a fair value today. There you are guys. I hope you enjoyed the video and thanks for watching.